Is the 60-40 portfolio dead? It's probably important that we start by telling you what the 60-40 portfolio is. So generally speaking, the 60-40 portfolio is 60% in stocks or equity and 40% in bonds or fixed income. And it's generally a moderate portfolio, a balanced portfolio for the average investor. Maybe it's a retiree, pre-retiree, or someone accumulating wealth who's not super gung-ho on risk, but not ultra-conservative either. And the question nowadays is this portfolio style dead? Given where the markets are? And the resounding answer is, well, I can't tell you that right now, but I'll give it to you at the end. So when constructing the 60 portfolio, there's different ways you can go about it. I'd say the most traditional 60-40 portfolio is 60% in just the generic S&P 500, which is US large company stocks, SPY, although I don't think that's necessarily the best index to use, although that's the ones quoted most in the news. I would much rather use something like the All Country World Index, or ACWI, which has more than just US companies. It's a global index and includes small caps. If you use the ACWI IMI index, that's a much more broadly diversified exposure than just owning one asset class, which is US large cap stocks and S&P 500. And the Barclays Aggregate Bond Index, which is most widely utilized for fixed income. It's a pretty good index. I do think you can do a little bit better if you go with, corporate bonds as opposed to the Barclays Ag, because that's predominantly treasuries. And I do think there's opportunity in corporate bonds for higher yield, although you do have to understand you're taking a little bit more risk when you're buying the corporate bonds as opposed to treasuries, which are safer. So that's generally how you construct a 60-40 portfolio: 60% equity, 40% fixed, and that's how it works. So after all, is it dead? Well, the resounding answer is no. It's definitely a worthwhile utilization and portfolio that you can have for the average investor, where you're going to get a broadly diversified basket of stocks, whether that's the S&P or ACWI, which is my preference, a broadly diversified set of bonds, and it can get you a normalized rate of return, call it between 4 and 8% annually over the long run. Now, we got to remember when we're talking about returns, in the short run, there's a ton of randomness. 25% of the time markets are down, talking about stock markets, 75% of the time they're up. Bonds, the ratios are a little bit higher, but here, as of 2023, we're experiencing the first time ever where we might have 3 years in a row with negative bond returns. So that's really hard for the retirees and the conservative investors out there. But again, back to the point, the 60-40 portfolio, I don't believe is dead. I think there's opportunity for that over the long run. Another benefit of the 60 portfolio, which is often unheralded, is the rebalancing return that it has therein. So the rebalancing is something you definitely want to do in portfolios to control for risk or standard deviation, or another word is beta for risk, where you're shaving off the winners. So when the equity markets are up, you shave off some equities and you buy into fixed income, buy low, sell high. That's basically rebalancing in a basic term, and vice versa. And you definitely want to have that exposure in any type of portfolio, but especially something like the traditional 60 portfolio. So again, this is not to be construed as financial advice. Thanks for tuning in. Withdrawal Investing Insights, signing off.